Hi everyone, this is Rob Roy and welcome to the Elliott Wave Elite US Market Update. I know we just posted a video a couple days ago, but there was a lot of volatility in the US markets on Thursday and Friday, so I wanted to come back and update you on what the charts are currently showing. As you know, we've been in this large wave 3, large and long, he tried to say, wave 3 to the downside, and we've bounced since then. We'll bring the Fibonacci retracement and extension levels on in just a second. But the first question comes, are we in the wave 4 now? Or it looks like we're moving up to that wave 4 level. Well, we need to look at the Fib retracement levels. I really like the 38.2% level as the first level of Fibonacci significance. So you can see we actually did go sideways at that 23.6% level, and we're headed up to the 38.2% level. We haven't gotten there yet. I'd prefer to see that, to say that we're in the wave 4 now. This is just a wave 4 bounce, pardon me, and we'll be heading back down lower. But I want to see that 38.2% Fib retracement level hit first. So with that said, let's go ahead and take the big pattern off and go back to the zigzag, the pattern within the wave 3, where we had the initial AB. You've seen this many times, so I don't need to go back and do it. If you're new, take a look at one of the previous recordings. And then here is our extension levels to the downside, where we came down to the 100% extension, then the 161.8, rebounded and hit the 100% level, and we did go ahead and initiate that SPY put debit spread, as I mentioned to you, just following along with our plan. And then on Thursday, we moved to the downside following Apple's surprise earnings warning. And not only did they warn, some people that actually did think the iPhone sales were slowing, etc., thought that the warning was even more than they expected. Well, then we come back on Friday and we get Fed Chairman Powell saying that the Federal Reserve will be patient in their rate hikes and that they'll follow the data and all that stuff. And so that gave the market a rebound back to the upside. So we turn around and move back higher, erasing Thursday's losses plus some. So now the question becomes that we have closed just above that 100% level. Are we going to go up and test that 61.8% level? That's what I wanted to discuss with you. Because remember, when we hit the 100% level, normally we would have gone back to that 61.8% level before heading all the way down to 161.8. Markets didn't do that, but maybe they're going to do that now before we head down to the 261.8% level, if indeed that's what the market does. So it'll be fascinating to see on Monday. I say that because a lot of the traders take the entire week off for the New Year's holiday, and so we won't be back at full volume until Monday in tomorrow's trade. So that'll give us a better idea of what's going to happen from here. As we bring the SPY in to bring volume in, you see the volume on both Thursday and Friday, the big down day and the big up day, are almost exactly the same. Remember, one of the other things we've talked about is some of the most violent rallies are in bear markets. And whether or not this one or this correction is over or not remains to be seen. You know the levels now that we need to watch to see how that occurs. But above average volume on both Thursday and Friday, considering the fact that not everybody was there, but probably will return back to even higher volumes at the beginning of the week, Monday and Tuesday, I would suspect. Looking at the VIX, we've come back down, and look, we touched this level at 24, and I've drawn these two trend lines here to see if it looks like maybe we're starting to find a support level around 24. We put the Elliott wave pattern on. That's also the 52% wave 4 retracement level. And that's fascinating, isn't it? Because if we hold there at an area of support, which also happens to be a 50% corrective move of the wave 3, that could be setting up for a wave 5 higher. If we break that level and come down here, I would say that that pattern is nullified. But at this point in time, that's what it looks like, which would certainly coincide with the markets heading back down to the 0.8% level. We did get a little bounce in interest rates from that level that we had talked about. Still amazing to see rates this low, and what occurred on Thursday was really shocking. If we look at the 10-day moving average, you can see that we got pretty far away from it on that drop on Thursday. We're still not back up to it, even bouncing back on Friday. And just as a reminder, for those that are new, no security in any time frame gets very far away from its 10-day moving average. So when we get extreme moves, we always check to see where the 10-day moving average is. Looking at the big Elliott wave pattern, you can see it's a wave 3 to the downside, which certainly makes a lot of sense. That definitely looks like a big impulse move lower. The only question will be, once the wave 4 does come about, will it bounce high enough to close this gap? It's amazing that that gap has been in the charts for that long. But I'm still fascinated by how low rates are in this environment, with the Federal Reserve not just raising rates, remember, but also reducing their balance sheet, which drives prices up as well. Drives rates up as well. Not prices, rates, just to be specific. So we'll see how the rates go at the beginning of the week. Do we get a little bit of a bounce? The 2s and 5s still remain inverted. 2-year and 5-year treasuries I'm talking about, the 2s and 10s have not inverted yet, but are very, very close. And that's, again, the big signal that most people say is signifying a recession on the horizon. Looking at oil, oil has bounced a bit as we thought it might, just from its oversold bounce. We look at the DMI, and you can see that the ADX is coming down, meaning that that downward move is weakening. So that would suggest the fact that we do have the ability to move back to the upside. We look at the Elliott wave chart, and we're in ABC patterns, so not a defined Elliott wave pattern occurring right now in USO. Again, leaving, in my opinion, the ability for it to bounce back to the upside. Could oil go lower? Sure it could, but is that likely? Probably not, in my opinion. Texas Roadhouse with our strangle, we're still right in this area of support resistance, testing it still. Move back up to it and look, close right on that 60 line on Friday. So it hasn't broken from this big descending triangle yet. Certainly expect that to occur in the near future. But maybe it has if we head back lower from here, and that's just the test. So we could have broken out, tested, and then head back to the downside. That happens just as often as when they break from the triangle and go straight, almost vertical on the breakout. Both of them happen equally as often in my experience. Looking at GLD, remember we did that big triangle in the last recording, and taking a look here, we did have a little bit of a pullback on the GLD level on Friday. So if we break to the downside, then we break to the downside, but we've got that massive triangle. I don't know that we'll necessarily, unless there's a lot of movement in gold, look at this one every week, because this is a much longer term thing, but we'll certainly visit it if there's any sort of significant move. So maybe we come back and set the wave 4 and break to the downside, or move back to the upside, which I would suspect is more likely, but the market's going to do what the market's going to do. Wanted to share an interesting one with you here. This is O'Reilly, and you can see that we've got this great symmetrical triangle forming here. And when I put the big Elliott wave pattern on, you'll be able to see that not only did we have the wave 5, but it went right to 61.8%. I mean, what an amazing thing Fibonacci and Elliott wave is. Dead on the 61% extension, and now we are consolidating, which happens quite often after wave 5s, as you know. And this is one of my favorite patterns for a breakout of the triangle. You have a completed Elliott wave pattern, really nice, well-formed pattern. Wave 5 at a major point of resistance to 61.8% fib extension, and then we're forming this triangle. Very likely to see this break out, and if it does, now the mouth of the wedge is 40 points. And we like to look at 80% of the mouth of the wedge. That's our target. So if the mouth of the wedge is 40 points wide, 80% of that would be about 32. The midpoint here is 340. So our expectation would be a break to the upside up to about 370 or possibly down to 310. Now the issue here is we're dealing with an equity shares that trade at $340 a share. Can't really just go out and put on a normal strangle, or otherwise it would be extremely expensive and outside of most guidelines and outside of our subscription guidelines as far as accounts and risk per trade. So what we can do is to do what I just call it double butterflies, where you set up a butterfly around the target to the upside. And even though I'm not a huge fan of doing bearish butterflies, as you know if you've listened to any of these recordings, because the speed of the potential movement to the downside, but in this case, to even out the risk, we do a call butterfly and a put butterfly to try to catch the breakout to the upside or the downside. So that's a pretty interesting case study. We'll follow along with this one and see which way it chooses to break. But a little bit slightly different strategy applied to it due to the fact that it trades at such a high price. Traditional, or I guess ours aren't really traditional because they're a bit proprietary, but our strangle even would be quite expensive for a share price this high. So anyway, just wanted to share those things with you. Hope you've had a great weekend. Be back to talk to you again next week. Take care, everybody.